Thanks very much. The next speaker, keeping in the Reuters mould, is Mark Worrall, who's going to step up to the podium now. Mark, welcome. Thank you. I'm very well. So we're just getting to know each other.
So, good morning everyone. Thanks to Herbie for inviting me, and I think he's asked me to speak a little bit about what it takes to establish a new exchange here in the City of London, I guess for a new asset class. It's been a 5-year road so far, so taken a bit of time. I started my career, as Bob just alluded to, in 1990 at Reuters, and the man who actually gave me that break sitting in the audience, that was Tim Dennis. Thanks, Tim. So after that I went to places like Algorithmics and set up my own company, which was later sold to Boston Consulting Group, Expand, and also worked in the retail financial sector and wealth management. The relevance of that is I very much identify with what Michael Manelli was saying earlier this morning about city plumbing. So if I'm an expert in anything, it's understanding how things happen in the city and how you put them together. So without further ado, let me tell you a little bit about the story. So let me just explain who we are. So what we're trying to do is take a project, whether that be a project which we put into an SPV, and actually wrap a bond around it and then list it on our own exchange, which is an MTF. So quite simply, what we're taking is project finance and then listing that, and hopefully the journey we're on is to turn a project into a liquid asset class, tradable asset class. And next year we'll add optionality, so you have an underlying instrument which is a bond, then you'll have optionality added to it, and then of course the nirvana mode is when you've got enough volume to create indices. So that's the journey that we're on. At the moment the problem is that mark-to-market doesn't exist at all. So if you go to, for example, a fund like Gravis, who our chairman is chairman of as well, what you'll find is that he has to go to someone like Mazars to have the valuation of those assets done by an accountancy firm, and then they have to do a director's sign-off on those. So they always trade effectively at a discount to the actual valuation, which is a good thing for them. But actually there's no mark-to-market for them, and therefore liquidity is at a premium and doesn't exist. So let me just explain how I came up with the original idea. So I was doing a deal, real estate deal near Tower Bridge, just where the DLR comes up, about Bank Station comes up into the site, and there's a slither of land there. And we had a company that was Malaysian company that was looking to buy this from the local developer. The main issue with that was that at the time, the banks were still siloed. So HSBC, which was the main banker, was actually not able to get the money into the deal because they were siloed in Asia and they were siloed here. And it became so we had to do an overage deal, so that meant the developer in question was paid at the back end. And my view at that point was, well, if the market's going to continue to look like that, then actually where's the money with the view, where's the risk parameters actually coming into the market? And what we really needed was the merchant banks that are, First World War were going to come back. But we knew that the regulators were never going to allow that amount of banking question. So there was a structural issue wrong with the market. So my view was, if we went back far enough, exchanges were a solution to actually look at an illiquid asset class, at that point real estate, and then start to look at how we might begin to take that forward to an exchange that actually was traded. So to that end, what I did was I went to the London Clearing House and started with the end in mind, and said to them, if I had an instrument, what instrument would you use? And we did an extensive piece of work with them, really to understand the thinking about what the instrument would be that they would be prepared to clear. And the answer was a bond. So that's how we got to the beginning, and I think the problem that we've seen is that most of the deals were being done by investment bankers. So there's a $2 to $3 trillion funding gap in infrastructure globally. It's huge, and that's the money that's not being deployed. And the reason for that is, if you've got the investment bankers typically doing the deals, what they're doing is they're tending to focus on those best deals, which is only a natural occurrence. And those main deals are really $500 million and upwards. But then there's this gap that isn't being done. And the reason it's not happening is because syndication isn't occurring with enough numbers. So in fact, an investment banker will want to put 1 or 2 people at most into a deal, maybe 3 or 4. But they really don't want to do it very much. So exchanges lend themselves very well to doing syndication. And in 2016, when Solvency II came around, we pivoted, to use the modern phraseology, towards infrastructure as a whole. So what happened then, that gave us a framework, if you like, a risk framework for us to attach ourselves to and actually begin to create an exchange to make that happen. And it has to be said that if you have, for example, if we're talking about foreign deals in particular, so one of our particular jobs is to work with the World Bank on their city resilience program. So that's the deployment of approximately $65 billion to 40 places, as they call them, or cities, around the world. And their issue for them is actually how do they get price discovery, how do they attract the private sector, how do you actually amalgamate money from different places? Because actually they only do 14% as a grant of any deal that they do. So they have to work with the local AFCs, the local IDBs, the local investment banks, and they have to work through those elements to actually find how they can get money in. And of course the private sector is huge. I mean, if you look at the PE funds, they're trying to deploy this $2 trillion of untapped capital that actually should go into the markets, which isn't making it into the markets for various reasons. But if they try and do it through their infrastructure teams, then they're always in competition with each other. So you tend to get very big deals getting done, but you don't get very well syndicated deals with lots of tranches. And so therefore the flow of deals is a really important component which an exchange can help to deliver and help to catalyse the market and make it happen. So let me just run you through how a project in the primary market, in the first issuance, the IPO, actually begins to come on. So you have an issuer, a project sponsor. So that sponsor could be private, could be public, or it could be a mixture of both. Doesn't matter. And it can be anywhere in the world. And we have the concept, a bit like you would, if it was the London Stock Exchange, you would call these people nomads. And we call them pilots because we're not the London Stock Exchange. So they're fully regulated UK entities with CF30 individuals who can promote a security. And what they're responsible for is to carry out the third-party due diligence. So in the case of a project, of course, it's not quite as simple as a company in one sense. You've got to carry out, if it was a bridge or a waste-to-energy site or a piece of solar, you need to understand, for example, if it was solar, it's very well sounds it's the same everywhere. But if it's in Africa and it's got intense heat, then it may degrade very quickly. So you've got to think about things. If it's waste to energy, is the thermometer in the right place in the kiln? There's lots of technical questions. So the pilot can do so much of the work, such as looking at the financial pieces. It can look at the legal due diligence. But when it comes to the technical due diligence, we have to put a cohort of other people around. And there's two types of parties that we work with. The first is consulting engineers. So you would have the likes of Mott MacDonald, AECOM, Turner and Townsend. So these companies are people that provide exactly this engineering knowledge that you need. So it's quite complex, but they have to do it at quite a detailed level. And what they're trying to do is to normalise that process for us. And then the other people that you would work to fill the gap to the financial markets from the engineering perspective are people like IHS Markit, who have got can provide the macroeconomic rules, provide the indices, etc. So the package of information that comes out of that is actually pretty complete in the sense that it puts us into the primary market. So they apply to the exchange, and as they apply to the exchange, they then provide two things. They create what we call a price discovery memorandum. And price discovery memorandum gives us three things. One is obviously the price of the coupon at par value, okay, which we take to market. So we don't price the coupon, but it's unlike what the banks and funds do now. They tell you what the price is of something. This is actually priced in the market openly. The second component is we get the depth of the market. So what's the interest in the issue? And this is a two-way street, obviously, with the pilot and the project sponsor. And the third component is what's the cost of actually placing that capital into whatever the location may be. And that's all done in the standard way. And then we go effectively to the auction, which is where we place the bond prospectus, and you make the placement and you're listed. So that's the way that all works. And that process, although it sounds quite long-winded to you in this room, the process from price discovery to placement is 16 weeks. Now, when you compare that with the market as it is today, an infrastructure deal will take somewhere between 6 and 9 months, maybe a year to fund. So it's quite slow if it's not already in security form. So I think someone was talking about earlier about refinance. We do greenfield as well as refinance, so it can be quicker. But I think it's important to note that that period is actually quite short. And then coming to machine learning, we'll actually be able to speed that process up. So we'll actually be able to bring it down to probably a shorter time frame that most of us can buy a house in normally in our own world. So coming on to some benefits we've done with the users for the use of the exchange. So if you are a fund, for example, you normally have a roll. Let's say you're a 5-year close-ended fund. You'll have a roll-on period and a roll-off period in the usual way. Right now, if you want to get rid of your funds, you probably have to start unrolling those funds somewhere about 3.5 years before the end of that period. If you know there's an exchange that actually will take project finance, that actually will take the underlying rather than the company or the fund that's actually listed, but actually underlying bonds themselves into the market, and we've got that constant volume sitting there actually looking at this from a focus point of view, then you can actually sell down into the market and maybe be able to hold your assets for not just 3.5 years, but maybe to 4.5 years. And that's just massive benefit to the client, because obviously the performance of the fund simply for holding the assets that you've taken a lot of time and effort to acquire actually now will carry on, but you can improve the performance of the fund itself. The second part is if you are looking to just exit the portfolio, again, you could actually just come to us and you could exit the portfolio as a whole, or you could exit over a period of time and sell down components as you go. Now, we will also be able to take equity, so we'll have it'll still be a bond structure, but we'd actually move it to trade it as an equity wrapper, as a bond wrapper in an equity form. So those are those pieces. So the some of the investor benefits. So pension funds, insurance companies are obviously suffering at the moment for very low yield, and obviously are looking for diversification. At the moment, if you look at, for example, in Australia, they're very good in the short-term liquidity, but are missing liquidity for the long term. And they've got capital adequacy rules which are telling them they've got to diversify out of Australia into Europe or wherever else they can find it. So there's an opportunity to swap actually Australian assets coming back over here for investors, international investors actually going over there. And if you think about it, it's actually quite a difficult thing to do. Actually deploying a team for your company over here to Australia, it's still a long way away. It's actually quite a difficult thing to do. So we had a roadshow with some of our people from Australia a couple of weeks ago, and there was a lot of interest from the UK pension funds and others to actually be able to use the exchange as a way of actually getting to a marketplace that is far away. And that would apply as much to a third world country, a renewable country which is an emerging country that actually has got problems trying to get the money to it. So if you think about it, it would be a lot easier if you are investing in a bond in Ghana that's going to have a project in Ghana through a London exchange with a rule of law based here. So it becomes a city story about how do you promote the city, if you like. People were talking about that earlier, I think, in terms of how do you put the city on the map a bit more going forward. And this would be a way of doing that as well. So for project sponsors, there's some really tangible benefits in particular. One is cost. So we're coming in somewhere around 50 to 60 basis points below on an IRR basis, but on the coupon cost. So that's a lot of money if you're talking about £200-300 million worth of bond. That's a lot of money you're saving. So I'll give you an example in terms of illiquidity. One of the issues, I was with the Port of Rotterdam recently. So they had gone out to the market for a particular plant that they were looking at on some of their land. And they went out to 7 financial institutions, and the spread for them between any of the financial institutions, they gave them the same piece of paper, was 500 basis points, which is huge. You wouldn't get that in any other market. So the inefficiency and illiquidity of the market is very obvious. So if we can try and help to squeeze that down, then that provides opportunity for everyone in the ecosystem available. The other one is a deal that we've just recently signed up, which is a gasification plant in the UK. Now, in this particular instance, the company in question is actually being funded by probably half a dozen institutions before. Now, the way that's typically worked is they've taken a project which has been which the developers turned up and said, please fund this deal. And the per se was £200 million. And what they've done is they said, well, I'll tell you what, I'll put in the £200 million, I'll give you all the money, and I'll give you a developer's fee, and I might give you a bonus if you deliver it on time. The problem is he's already done 6 of these, so he's got a track record. And you can't get the money that actually supports the position where he can actually just get the debt and actually build his own balance sheet rather than everybody else's. So the reason for using us, he's got enough money to put the equity in now. So he's using us to effectively enable his balance sheet to be growing by simply coming to us for the debt and actually being able to do the next 3 deals, which probably is about £600–700 million worth of projects. So he's going to get quite rich out of that as the asset matures and he's able to hold on to it. So it's quite an important component compared to some of the other market parts of what happens elsewhere, which is typically, it's quite difficult to market. And he saves himself a lot of time as well. The road shows, the cost of doing that, etc. The final part is data. So unlike crypto or indeed other more mature markets, this is actually a very, very quiet market. I was actually shocked. It's more 1990 than 2019 in terms of data. I was talking to a construction company the other day and I said, what do you do with your data? And they said, well, after 12 weeks we throw it away. Right? So everyone in this room, that would be a sin. But they do it regularly. And even I'll give you a comparison. We've got someone working with us in our team. There used to be the superintendent on Paddington Crossrail, so he was actually the man making sure that the box that went in the right places, etc. And even the experiences that he had, because I think he was doing the work just ahead of Bond Street, wasn't shared across the group. So what they were doing in Bond Street was never shared, in Paddington, wasn't shared in Bond Street. So it's really interesting that that type of information, you'd have thought that would not be the case, but you go to a lot of the conferences on the engineering side, and I've been to several, and they're still struggling with the base idea of how you collect data. So what we've done is we've tried to look at 4 silos with the exchange. The first is obviously the project sponsor. The second, of course, is the money. The third one of those is the construction companies, so there's some of those we're familiar with have gone down recently. And the fourth one is actually the insurance companies. And what blinds those 4 pillars, if you like, is actually risk. But the question with it, if we think financial markets are complicated in terms of data, you just imagine trying to work out how many data components there are in an infrastructure project. So you have to try and normalise that framework in some way. So what we've done is we've used different classes, so there's something called BIM, Uniclass, etc., to kind of come up with ways that. So what this means in simplistic form is if I'm trying to compare a school with a school, I've got a fairly limited data set in terms of my ability to compare data as a comparator, even if it's across the procurement pipeline. Okay. But if I look at it in terms of an air ducting system, then obviously that opens up a whole range of other information. I'm able to not compare only a school with a school, but I can compare a school with an air ducting system with lots of wherever other air ducting systems are in place. And that means that we can build data sets from the bottom up, which enables us to then have a look at risk in different ways. And this launches later on this week, so we're actually just about there. The exchange itself will open in Q4. We've seen approximately £50 billion worth of origination since September 2017, which hard filtered that down to about 10. So we've got that in the pipeline coming through. And I guess the biggest piece really is working with the World Bank and the IDBs, because that is actually coming back to the ability to actually be able to look at how resilience, so we're working on a resilience index with them as well. So what would that look like, which sort of falls into the sustainability and putting something back. But also other IDBs who work in partnership with the World Bank, which is difficult. It's not an easy thing to do because they're big organisations who move slowly. But if you can marry it to the private capital, it's actually looking for a home. So if you can imagine in this low yield environment, we're talking about returns that are somewhere between 3–4% at the lower end for something that's being refinanced, and very long tenor. So if you go to a sovereign wealth group, so I was sitting with someone the other day, they'd give me 150-year money if it was a PPP, a public-private partnership. 100-year money would be prepared, which is a huge timeline. You don't see those. But if you look at, things like, sorry, I lost my track now. So yeah, so you've got the tenor, you've got the World Bank and their part. And then I think for other people, you're looking at private projects where they're looking at better rates. And because the tenor is longer, it actually is more attractive for them because they make money sooner. So if you're looking at it purely from a commercial point of view, probably some of us in the room are not getting any younger. If you can start to get the returns and you've got a longer period, a longer tail, then that can be paid off by the next person kind of taking up the job coming down the line. So as I say, launching next quarter, or this quarter now, sorry, it's the first, isn't it? So this quarter, and then we've got the data later on this week. Yeah, so if you've got any questions or want to talk to me about it, do. It's been a long journey, but we're nearly there. Just a big shout out to Aquis. So we're working with Aquis on the technology. So we decided not to to build the technology, we decided just purely to build it. So we're doing that. We have BNY Mellon working at the back end for delivery versus payment. And we work with IHS Markit, as I mentioned, major engineering firms. So it's quite a good cohort of partners. In terms of the investors, it's all the suspects you'd expect, from the very big pension funds, insurance companies, banks. We've got some market makers as well. We're ready to go. Thank you very much. Happy to take any questions.
Mark, thank you for that. Setting up an exchange in this day and age must be quite a challenge. I'd be interested to understand the attitude the regulators took towards a new exchange being set up and the complexity of cross-country, cross-continent regulation as well.
Okay. So yeah, it is a challenge. Especially if it's new, and it's the first bond exchange as well that the FCA has done as a pure bond exchange. So they've had various queries around that. The way we've done it is by using the good auspices of Aquis, actually. So we're actually coming in under their licence as an MTF. That's how we've done it, which means that the questions the regulator has are less onerous than if they would be if you tried to do it directly. So that became something that was fairly obvious, and their stewardship over that has been fantastic, I have to say, both on the technical side and on the regulatory side. The way to get around the international piece is we're only regulated here. We're not planning, although the projects may be elsewhere around the world. We do the projects in London and we're fully regulated. The regulations would be fully formed here to do that. So you don't actually spread the regulation anywhere else. So all the clearing, all the settlement, everything is done here. So that's why it becomes a City of London story. I knew that was coming.
From a pure real estate perspective, IPSX have struggled somewhat. Where do you see what you're doing is going to be fundamentally different than what they've done?
So if I've understood their model correctly, and you can correct me if I am wrong, because I haven't spent much time with them, but as I understand it, what they're doing is they're putting in equity and trying to perhaps take 20% of the standing assets of a building like the Gherkin and making 20% of that available as equities and then listing that on their own IRE, regulated investment exchange. And then what they're doing with that is selling it to the retail public. So the idea being it's sort of the old story that we've had between the LSE and Deutsche Börse and Borsa, etc., being taken out of competition, and then the MTFs, etc., taking over to spread that competition to improve pricing for the retail investor and the pension funds in particular. So, that makes sense in that sense. What I can't understand in that model is what's different for me is I don't understand why you would buy and sell it, because if you and I managed to get hold of a piece of the Gherkin, unless something happened to your portfolio particularly, and it's got 25-year upwardly mobile rent reviews, I would suggest that you probably want to keep the asset as an asset-backed security within your portfolio. So that's the bit I don't understand, is how they create volatility. The difference for us is if you're a greenfield site, or in fact any piece of infrastructure based on, especially if it's in a place like an emerging market, there's quite a lot of moving parts in that, and there's volatility there. And obviously volatility is key to creating liquidity. The recipe card it's not mine, I'm glad to say. There's a guy I'm sure some of you know called Richard Sandel, Dr. Richard Sandel, and so I had the pleasure of pressing the LinkedIn button and talking to him a few years ago. And he wrote a book actually. I'm definitely on family book commission with him. When I started talking about his book, it was £15 a book. It's now 60. But if you follow that book from our perspective, it's very much a handbook for how you might establish liquidity on an exchange, and how do you create volatility, and how do you create the price tension that you need. And we spend a lot of time thinking about how that works on this, which is why we added the optionality into the deal. So actually you can have puts and calls, and of course if you think about it, depending on where the project is and what it is, so if you take waste to energy, even in the UK, it's a fairly volatile asset class still. It's not very well established, so you'll be hedging it fairly tightly even if you put a straddle on. If you talk about talk about somewhere else like Canada and it's solar, or maybe not solar, but maybe solar in Canada, then it would be fairly, your distribution curve of risk is going to be fairly flat, and you probably won't hedge it at all. So it's that hedging ability that will begin to bring a differential as you try and normalise. And obviously you can arbitrage between the physical market, which I was talking about earlier when you've got funds, and this market. So that would be some of the answer towards how you create liquidity. Anyone else? No?
Thank you very much.
Thank you.
And there we are, ladies and gentlemen, there you have it. So thank you very much, Mark, until this afternoon. So we're going to resume at 1:10. We will start at 10:10. We've got a lot to pack in this afternoon, as much as we've had to pack in this morning. So if you want to be here at the beginning, you need to be back, as I say, at 1:10. Lunch will be served outside, and unless you have any further questions for me, enjoy your lunch and we'll see you later on. Thank you.